The current live trading price for Snap Inc. is $7.64 USD, showing a positive intraday movement of roughly plus 0.27 points or 3.60% as of this very moment. When you see a stock trading under $10 that used to command the attention of the entire world, the immediate instinct is to look away, assuming the story is over. But right now, looking away from Snap Inc. might be the single most expensive mistake an observer could make in this specific market cycle. The expectation across the broader financial media is that Snap is a legacy social media platform, slowly bleeding out to vertical video competitors, destined to fade into irrelevance while bigger players consolidate the advertising market. That is the comfortable, easy narrative that keeps retail traders sleeping at the wheel. The reality, however, is significantly more jagged and uncomfortable. Snap is currently undergoing one of the most aggressive under-the-radar infrastructure overhauls in its history, and the price action we are seeing today at the $7.64 level is not just noise, it is a battleground where institutional accumulation is colliding with retail capitulation. While the average investor on Robinhood or SoFi Active Investing dashboard might see this 3.60% bump as a random fluctuation, the order flow suggests something far more systemic is bubbling beneath the surface, specifically related to how the company is quietly re-architecting its ad delivery algorithms to bypass the signal loss that crippled them years ago. You need to understand that the price you are seeing on your screen right now is a liar. It tells you where the stock is, but it deceptively hides where the momentum is actually building. Most people look at this chart and see a flat line or a slow decline, but if you strip away the noise and look at the volume profile, we are seeing pockets of accumulation that typically precede a volatility expansion event. This is not dissimilar to the quiet periods we have observed in stocks like Tesla stock before a major narrative shift, where the price stays suppressed while the fundamental thesis completely inverts behind closed doors. The market believes Snap is an advertising company failing to sell ads. The contrarian reality is that Snap is morphing into an augmented reality utility provider that just happens to sell ads to fund its R&D. That distinction is what separates the people holding the bag from the people spotting the value. Let's talk about the immediate price action we are witnessing today because it tells a very specific story about market psychology. The stock opened lower but found immediate support, pushing up to that $7.64 mark. This indicates that every time the price dips toward the historic lows of $7 or $6.90, there is a programmed buy response, likely from algorithmic trading desks or specialized funds that see deep value at these levels. If you were using a platform like Interactive Brokers or watching the flows on a Fidelity Active Trader Pro terminal, you would see that the bid sizes at $7.20 and $7.30 are thickening. This is smart money establishing a floor. They are effectively betting that the downside risk is capped while the upside optionality remains uncapped. This creates a risk-reward asymmetry that is rare in today's overextended market. While everyone is chasing all-time highs in the semiconductor space or trying to figure out if Nvidia stock has more room to run, the real alpha often sits in these beaten-down names where the bankruptcy thesis has been disproven, yet the growth thesis hasn't been fully priced in. The broader market context here is critical. We are in an environment where advertising spend is recovering, but it is recovering unevenly. The giants are eating the most, but Snap's recent earnings data, specifically the Q3 figures showing daily active users growing to 477 million, proves that the death of the platform has been widely exaggerated. You cannot kill a platform that is adding millions of users year over year. The disconnect, and this is where the opportunity lies, is between that user growth and the monetization per user. The market is pricing Snap as if those users are worthless. The reality is that those users are the hardest demographic to reach, Gen Z and young millennials who do not watch cable TV and barely engage with traditional Facebook feeds. Advertisers are desperate to reach this cohort, and Snap still holds the keys to that kingdom. I want you to pause for a second and think about your own portfolio. Are you allocated to these high-risk, high-reward turnaround plays, or are you strictly sticking to the safety of index funds? Comment below how many shares of Snap Inc. you currently hold, or if you stayed away entirely because of the volatility. I want to see if the sentiment in the comments matches the bearishness in the press. Now, we need to address the structural mechanics of why the stock is moving the way it is. When you look at the technicals, the $7.50 to $8 zone has become a massive friction point. Every time the stock tries to break out above $8, it gets hit with selling pressure. This is classic overhead supply. Investors who bought in at $9 or $10 months ago are waiting to get out at break-even, creating a ceiling. However, today's move to $7.64 on decent volume suggests we might be chipping away at that resistance. If Snap can close above $8 and hold that level for 3 consecutive sessions, it triggers a completely different set of technical signals that could force short sellers to cover. And make no mistake, the short interest in Snap is not negligible. There are funds betting heavily against this company, and if the price creates a higher high, those short positions become fuel for a squeeze. Consider the retail investor using Robinhood stock trading apps or the SoFi active investing dashboard. They see a stock that is down significantly from its highs, and they think, bargain. But a low price is not a bargain if the company is broken. Is Snap broken? That is the question. The bear case is that their ad tech is inferior to Meta and TikTok. The bull case, which is gaining traction today, is that their direct response advertising revenue is finally turning a corner. They have implemented new machine learning models, pixel purchase optimizations, that are showing a 30% year-over-year growth in conversions related to purchases. This is the boring technical stuff that doesn't make headlines, but it is exactly what sends a stock from $7 to $12 in 6 months. It's the plumbing. When the plumbing gets fixed, the revenue flows. If you are managing your own money, perhaps through a self-investing setup or even something as automated as Schwab Intelligent Portfolios, you have to ask where Snap fits in. It is not a core holding. It is not a safe haven. It is a volatility instrument. It acts less like a steady compounder and more like a call option on the future of social interaction. The volatility here is high, which scares away the Fidelity wealth management types who prefer steady dividends, but it attracts the aggressive traders who know that a 20-cent move in Snap is a much larger percentage gain than a $5 move in a mega cap. Let's shift gears to the business model itself, because there's a massive misconception here. People think Snap is just a messaging app where teenagers send disappearing photos. If that's your thesis, you're missing the entire point of the last 3 years of their development. Snap is an augmented reality company. Their lenses are used billions of times per day. Why does this matter? Because the next major computing platform after the smartphone is likely to be AR glasses. Snap has been building the operating system for this future, Snap OS, while everyone else was distracted. Their spectacles, hardware, although not a mass market hit yet, is the prototype for a post-smartphone world. The market assigns almost zero value to this option. They treat Snap's AR division as a cash incinerator. But if you look at the engagement numbers, 350 million people engaging with AR every single day, you realize that Snap has the largest active AR user base in the world, bigger than Apple's Vision Pro user base, bigger than Meta's Quest user base. They just haven't monetized it with hardware yet. They are monetizing it through sponsored lenses. Furthermore, we have to talk about Snap Plus. This was dismissed as a gimmick when it launched. Who would pay for Snapchat, the critics asked. The answer is millions of people. Subscription revenue is running at an annualized rate of nearly $1 billion. This is high-margin, recurring revenue that cushions the volatility of the ad market. It proves that the users are loyal and willing to pay. This shifts the fundamental analysis of the company from a pure ad play to a hybrid subscription model, which typically commands a higher valuation multiple. If you are analyzing this stock on an interactive brokers platform, you need to adjust your valuation models to account for this sticky subscription revenue, which is far more predictable than the holiday ad spend cycles. There's also a geopolitical angle that we cannot ignore. The potential ban or restriction of TikTok in the United States remains a massive black swan upside event for Snap. If TikTok faces legislative hurdles or a forced sale that disrupts their operations, the immediate beneficiary of that ad spend migration is Snap. Advertisers can't just dump all their money into Instagram. They need diversification. Snap is the only other viable video-first platform with the reach to absorb that budget. The market has priced in some of this possibility, but not all of it. If you believe the government will eventually clamp down on foreign-owned social media, holding Snap is a direct hedge against that geopolitical risk. Let's look deeper into the recent market movements over the last quarter. We saw the stock drop after earnings despite beating on revenue. This is a classic